Well, good afternoon. When Lisa asked me to join you, I said, tell me a little bit about what I'm getting into. She said, we're going to feed them a really good meal. Jim, who's an excellent speaker that I know is going to talk, and then you're going to cram really complex tax subjects into 15 minutes and hope that you don't put them to sleep. So join with me. I'll try to make this concise. My heart is you wouldn't be here if you weren't trying to be a better steward. And the reality is I do believe that those that write the tax code keep it sufficiently complicated so as to give them job security and to fund their power through taxes. And so although we all should pay our keep, paying no more than that, I think, is our mandate. Let me qualify this by saying I'm not a CPA or tax preparer, but I am a certified financial planner. I grew up in East Tennessee, got a chance to go to Carson Newman, jumped out of perfectly good airplanes, only to decide that coming back home was the smart bet, and have been back here for 25 years. My office is in Sevierville, as well as we have one just down the road here in Knoxville that I work from. To that end, I've got 4 key things that I'm going to try to cover. And really my goal here is not to fundraise, it's to say, how do we remove friction from the way that we give? So I hope that you walk out of here with 1 or 2 nuggets that takes the dollars that you are giving and gets more of them to the ministry that you care about instead of the government that maybe we don't. So I'm going to cover directing, growing, timing, and prepare. And I'm going to start with direct because it's kind of in an island all to itself. So I suspect most everyone in here has a pre-tax retirement plan, whether that's an IRA, SEP IRA, simple IRA, 401k, 403b, 457. Those dollars went into that plan before you paid any taxes. And the federal government gave you that tax break. As a matter of fact, if you think about it, if you had $1,000 and you owed $200 in taxes and you would have gone home with $800, you really were investing $800 of yours and $200 of Uncle Sam's pre-tax. What happens is at 73, we all know, the federal government says free tax deferral is over and we want some skin. And so this thing called required minimum distributions happens. And in essence, your 1231 value of the preceding year is divided by a life expectancy table. Now, to oversimplify that, because we all understand percentages, it starts off at 3.8% at 73. And of course, as we get older, even if we don't have the genes of Jim and his family, our life expectancy decreases. And as our life expectancy decreases, that percentage increases. And so all the federal government is making us do is take a withdrawal. We don't give it all, we just run it through our tax return finally. And the old way was that you pulled it out of whatever the retirement account was, paid the taxes, put it in your bank account, and either lived off of it or were generous with it. The qualified charitable distribution is the better route. You send the money direct to the ministry and it bypasses going through the tax filter. So if your required minimum distribution is $10,000 and it goes direct to the ministry, you have 0 taxable income and the ministry has usage of all those funds. Now, a common question I get amongst the clients that I serve is, do I have to send all of my RMD? And the short answer is no. Or do I have to send it all to the same charity? And again, the answer is no. So you can be strategic with this, but it's in essence the same generosity with a cleaner path and no unnecessary taxation. Next, I'm going to talk a little bit about growing assets. Now, this could be stock or it could be property. It's anything that you purchased at a price at one point that's worth more now. At some point, as you look to potentially liquidate those assets, whether it's a piece of property you're selling or a stock that you're reallocating or liquidating to live off of, in the normal path, you would sell that appreciated stock first, pay whatever capital gains tax that was due, and then give or live on what remains. A better path is to give the stock or the appreciated asset directly to charity with the full value reaching that ministry and avoiding the capital gains altogether. So here we have a stock, or again, it can be a piece of property, a business that has a $20,000 basis, or that's your total cost for your acquisition, and it's now worth $80,000. The full $80,000 is gifted, and that $60,000 gain is something that never shows up on your tax return. So the intent here is to give what God has grown without erosion. Next is bunching. This is especially important in 2026. So what is extremely complex, I'm going to try to make simple. If you are a person that gives annually, and I believe everyone in here is, and I'm just using in my example $15,000 a year. It doesn't matter in this instant whether you give 1,000, 100,000, or $1 million in a year, unless you give to a level that meets these two criteria down here, that exceeds the total. You're going to itemize if you're going to get a tax benefit. And so in 2026, married filing jointly, it's $32,200. If your itemized deductions don't exceed that, then your annual giving doesn't have a tax benefit. Not
Question.
okay.
Is that what the one big beautiful bill?
This is the one big beautiful bill. I'm getting ready to get to part 2 of that in a second, Kobe. And so the other oddity is this. See my little second bullet point? There's a new hurdle. You have to clear the 0.5%. Trust me, it won't stay at 0.5%. AGI floor on charitable gifts. So you make $200,000 of income. We apply that 0.5%. The first, so that's $1,000. The first $1,000 you donate is not even eligible to be itemized. And so the concept here is, rather than giving $15,000 a year or whatever is below the itemized level, what if you bunched your giving and you gave 3 years in 1 year? Now, some of you may go, well, I like giving it as I go, as God leads me. Next slide will cover that. But what bunch giving says is, I'm going to give all $45,000 in 1 year, itemizing that year, and then I'm going to take the standard deduction in the subsequent years, right? So you're given the same over the 3-year period, but you're choosing to bunch, and especially in those years possibly when your income is higher, whether that's an asset sale, higher income bonus, whatever it may be. And so the concept here is, instead of $15,000 in a year, year after year with no tax benefit, you bunch those gifts into 1 year for $45,000, itemizing and saving that year, and then taking your standard deduction in subsequent years. Same total giving, with a much better tax result. The common comment I get on this is, well, Andy, wait a minute. What if, again, I want to give as God leads year after year? And that's where the usage of a donor advised fund comes into play. Now, you can do a donor advised fund with any custodian, multiple custodians out there, but think of a donor advised fund, and I'm going to make it super simple, as a Roth IRA for your giving. You put the dollars into the account. You are as conservative, moderate, or aggressive as you want, so it can be like a bank instrument or a diversified portfolio, whatever you want. And you get a deduction. It's an irrevocable gift for whatever you give. So think back to that bunching. You do that $45,000 because you want to go ahead and get that tax benefit that year, or you have a high taxable event that year with a sale of an asset or a bonus or an equity buyout in a business you own, whatever it is, and you give it to the donor advised fund, okay? The reason that's better is, instead of giving as your income arrives each year, if you're strategic with a donor advised fund, you get the full deduction in the year it goes into the donor advised fund, and then you get to direct how it's invested, and you get to direct over time when you want the amounts you want distributed to the charities. Now, you don't get another deduction then. Remember, you got the deduction when you made the deposit, so there's no deduction on the future distributions, but it's a tool. In essence, it's like a family foundation without the complexity and expenses for you to park dollars into an account designated as a donor advised fund for you and your family to rally around if you do want to give a large gift in a given year. So high income year or bunch gifts into the DAF, and then you can give it gradually over time to your discretion or all at once. There's no, you control the gate on when it's distributed. So you're planning ahead, you're involving your family, and you're giving thoughtfully and strategically. So my goal here, again, some complex tax stuff around investing, retirement planning, and charitable planning, is that you give faithfully and wisely in ways that ensures more reaches the mission, and every dollar you intend for ministry arrives fully. I think we're doing Q&A at the end. Okay, or I can take questions now, whatever you prefer. As I said, there's my contact information with offices here in Sevierville and Knoxville. Glad to help in any way I can. I hope, I didn't put anybody to sleep, so I'm going to call it a success, but I hope this was meaningful and beneficial. And thank you for your time.